Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week, it's our series on life insurance audits, and on today's show, life insurance as an asset. And with me today is CPA Richard Newman. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to the show, Richard.
Thanks.
Day 4, and you know what? I have to say, until I started talking to guys like you and other people that are really into this, life insurance as an asset. I can think of life insurance as an insurance issue. I can see life insurance as indemnification. I can even understand it as an inheritance play to pay taxes with leveraged dollars. I get all that. But now we're talking about a balance sheet issue where a death benefit could be present future value. We could be talking about cash value accumulation. Could it be a standing balance sheet asset? Talk a bit about this, because I think people keep thinking I'm going to quarantine life insurance into protection and coverage and indemnification, and that's all I see it. Introduce us into your thinking as a CPA.
Well, I think you got to start as a CPA with the tax benefits of life insurance. The death benefit goes, if properly structured, there's no income or estate tax on it if done correctly. Pretty big, significant opportunity there from that standpoint. Also, think about the tax benefits of the cash value of life insurance growing without the payment of tax. And you have a small mortality expense, which is less than the payment of tax. So,
can I stop you there? Do you use that arbitrage, the way you've just expressed that, is that you're comparing your cost of insurance against taxes due if we were outside the tax advantage wrapper of life insurance?
It's an arbitrage. And that arbitrage is the difference. Somebody may not like life insurance. People say they don't like it, by the way, just a sidebar there. I've never given a death benefit to somebody that they said they didn't like or didn't want. But a lot of people don't like it. I think people don't like to pay for life insurance, Steve, is what it is. No, but what really we're talking about from an accumulation standpoint. This accumulation can be used by individuals as an asset class. And by the way, with waiver of premium, if you can't work and you can't make that premium payment, it gets paid on your behalf. Where else could a piece of your retirement plan become somewhat self-completing?
Can I stop you there again? I'm
Sure.
so sorry. Do you sell waiver of premium? Because I think it's lost its kind of glamour over the years, but you like to put this into self-complete if disability occurs. Talk about that.
Where else can you do it? I mean,
You can't.
if you were making a $30,000 contribution to your retirement plan every year and got sick and couldn't work, who's going to make it on your behalf? Not you. That same $30,000 was committed to a life insurance contract. If you got sick and couldn't work and adhered to the terms of the disability waiver, that $30,000 gets paid as if you wrote the check, which means not only do you have life insurance, that accumulation is going to take place as if you had written the check and you didn't become ill. So there's two different areas. It's all based upon tax code, and the tax code is very favorable to the life insurance industry. But think about it. If you're an affluent individual and you care, you got to do two things. You got to be affluent and you got to care. You got to love somebody, which means, and if you do, are you really just investing for yourself? Are you investing for a family? Are you investing for a charity? You're investing for somebody else. And now when we take a look at that, aren't we trying to allocate to various investment classes? All of my clients own real estate. They own stocks, they own bonds, some of them own businesses. Some of them own significant amounts of real estate as a real estate developer type of person. All those assets, we're planning to pass those on to the next generation. All those assets are based upon some strategy, based upon the economy and how well that economy is performing, how well is the market doing, how well is the real estate market's doing. Life insurance, when you start to put money into a life insurance policy in the form of premium, and I know I've got a death benefit, when we're all done and I've paid those premiums, couldn't I figure out what the rate of return I got on my money that I put into the life insurance to develop the death benefit? If we structure a product correctly and somebody's buying life insurance for estate taxes, I'm also looking at the rate of return on premium to death benefit, and our goal at life expectancy a little bit thereafter is somewhere in 7, 8, 9, 10% income tax free. So again, if my client cares about somebody other than themselves, and they care about what they're leaving, be it to their family or to charity or somebody else, that we can then utilize that life insurance premium compared to death benefit as an untethered asset class. It has no relationship especially if you use a guaranteed premium, a guaranteed product. So it's no relationship to what the stock market's doing at the time. As a matter of fact, it's the only asset produces significant cash at the time you die, and it's not an illiquid asset. So that's one area. And I have clients who don't need life insurance, but they've recognized this, and they recognize that they want to diversify. And one of the ways for them to diversify is through reallocating instead of, as their CDs and as their tax-free bonds are coming due, let's allocate these dollars here because I'm not using that income anyway. On the other hand, because of the tax laws surrounding the cash value of life insurance, big businesses utilize life insurance as a cash value play in the form of deferred compensation agreements on the balance sheets of their firms. Banks use bank-owned life insurance as an arbitrage play in that vein. You and I can use life insurance because of the tax benefits of life insurance growing without the payment of income tax. We can also access the money without the payment of income tax. As we discussed in the past, we just have to be careful and make sure that policy is enforced at the time we die. And we can also select by using that the type of product which will give us the type of risk profile we're looking for. Am I somebody who's historically devoted my assets to CDs? Then I'd use a participating whole life contract. Am I somebody at my client counseling that this person is a stock market player? I'm going to go to the opposite end of the spectrum and use a variable life insurance product, which transfers the risk of the investment from the insurance company to you in the form of sub-accounts, which are really mutual fund.
Well, it's life insurance as an asset, and I love your line about it not being correlated to the stock market. I think that's a huge bonus when you're talking about life insurance as an asset. When we come back from the break, we're going to continue addressing life insurance as an asset beyond the traditional indemnification purposes as part of your overall business strategy that you can position your practice as the premier provider of product information. Hey, not only to the fiduciary market, but also to prospecting tactic for new clients in your community. And you can request your own life insurance audit on your clients at downtobusiness.ashbrokerage.com. Just fill out the request form, and don't forget, while you're out there, take the 30-day free trial for Backroom Technician. Just go out to their website, brtnow.com/trialsignup.aspx. We'll be right back after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back. I'm Steve Savant with Richard Newman, and remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, right out at ashbrokerage.com. Just click on the show logo on the homepage. It'll take you right out there. And just a heads up, before moving forward with any of the ideas on our show, always consult your tax advisor or legal counsel, as well as your broker-dealer compliance officer, although I have here Richard Newman with me, CPA. That's all the counsel I need. Let's get down to business. We're talking about Richard's piece. I love this piece. Life insurance as an asset. This is your piece.
It's our piece.
This is your piece. And normally I would look at this as saying, this is a stately art of propaganda, but I have to say, this brochure is really a great piece for clients to understand what they're getting into as an asset. And if you are sitting there saying, Steve, I've never heard anybody articulate the way Richard did in that first segment, which I have to say was very high performance on your part.
Thank you.
If you're saying, I've never looked at this like this. I've always looked at it indemnification, coverage, protection, never as an asset, whether the future death benefit or my cash value accumulation. This is a really good start for you. And if you say, Steve, I need to partner a few cases like this, and of course, you can always get in contact with Richard through our company, happy to do so. Richard, when you did this, and again, as a CPA, remember, I could see me doing this, but this wouldn't have the glamour it has because I don't have a certified public accountant behind my name. When you did this, what were you thinking? You created something here that, in my view, is a little bit of an anomaly.
Well, if you take a look, that's on the bottom right of that is our My Life Giving logo, which really is something that's utilized for charities and how we created this. And what we're really saying to affluent individuals is, in that vein, is you can give money now, or maybe you can give money later. Mm-hmm. And if you're trying to endow something, why not use life insurance as an asset class to do that? Because the rate of return is probably going to be better than you get on another asset to be able to do that. The context also was that charities are sitting on life insurance policies, or their donors have life insurance policies that they own themselves. And what we were trying to do with this piece is to prompt them to look at those policies to see if we could find any arbitrage in those policies, see if they're underperforming, and possibly even get additional death benefit for the benefit of the charity, or to reduce premium, which could be used as an ongoing immediate gift to the charity.
Now, when you review this, and let's just stay in the vein of the charity for a moment, when you review this for a charity, I've noticed outside in normal life insurance that every time we do a review, almost 65% of the time I can better a client's position, whether it's death benefit or reduce the premium or do better cash accumulation job. When you're into these higher net worth affluent clients, do you still see the same kind of percentage? Is it 60, 65% you can do a better, or is it higher than that?
It's probably even higher than that. But the one thing that, number one, the anomaly is there, and the arbitrage is there. But the one thing that life insurance does when you're talking about in line with a charity or philanthropy is it's clear that the level of generosity a philanthropist has with a charity is directly related to how they feel about that charity and the connection to that charity. And when we're reviewing life insurance policies, I think the mistake we've all gotten away from is looking at them. Just because somebody has $10 million now and I can make it cheaper, I have to go through my same level of due diligence, which is, why do you own this policy? What other assets you have? Who do you love? What do you care about? What's your legacy? Every time we've gone through the process with a donor, we have been able to make that donor closer to that charity, and they become even more bound to that charity. So as a result of the life insurance audit, we're finding dollars that they didn't realize that they had, and we're finding empathy that we didn't realize that they had as well, and why, and really getting some to think about what they did. And every time I wrote a check to that charity, every time I volunteered at a bake sale, how did that make me feel? And when I'm gone, are my kids going to maintain my level of commitment to that charity? It's so ironic that when life insurance is sold correctly and understood what's there, that all comes out. So everybody benefits. Ironic part about it is half the time we find monies that the client is using they didn't even know to further their philanthropic journey.
When I'm looking at your brochure, My Life Giving, when I see this brochure, I'm thinking the charities must love this because you're endearing them even a closer relationship. You're actually being part of generating a closer relationship with the charity. The charities have to see this. Does that also lead to secondary business?
It does. You also have to understand how life insurance is viewed in a philanthropic format. We cannot lead with life insurance. We have to lead with what's in our heart. And there's study after study that's proven that the tax code really has no bearing on how much money is donated, which is really ironic.
Well, can I stop you there for a second then? So you're saying we could have the deduction all you want. The person's giving to charity because they have an affection for it.
Right. And the affluent client that gives to charity, remember, still some of it's staying back with them. You're not giving, it's not a dollar for dollar deduction. So you got to care about something. And so, and it's proven, and it was a real surprise to me over the last few years to really come to that conclusion. And I'd started on a trip to Washington that I was on a political trip to Washington. We had some long discussions about that. What's clear, even if the tax code does help somebody to make a larger contribution they would have, because that's possibly where the collaborative planning table comes, where the CPAs are, the attorneys are, the charities there, the insurance advisors there, and the person who has the closest relationship with that client sitting right next to them, and will help them to make these determinations. But it all starts with that connection, and understanding how life insurance is going to be used is a real start on understanding how that should take place.
It has a lot more to do with their heart than it is their wallet.
Absolutely.
That's a huge issue, and I'd love to see our prospecting go that way. I'd like to learn more about that. Well, that's our show for today. Don't forget, you can read all my online insurance news commentary, advisor blogs, and articles on Producers Web, as well as my answers to consumer questions on the Insurance Library. Remember, you can view any of our past episodes right on our on-demand video section located at downtobusiness.ashbrokerage.com. So follow me on Twitter, Facebook, LinkedIn, or just email me, steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. We'll see you tomorrow.